Fundstrat's Tom Lee stated before NVIDIA earnings that as long as NVIDIA did not miss expectations, you were likely going to see a broadening of the markets following NVIDIA earnings. Well, the day after NVIDIA reported earnings, the stock was up about 10%. The rest of the markets, I mean about 95% of stocks, sold off. But what happened on Friday was about 90% of stocks were in the green. So I don't know if it's yet decided, but the only logical path ahead for markets is likely a broadening out to not just be so concentrated in AI and big tech. Meaning that if you own some of Tom Lee's granny shots, like a PayPal for an example, those should start to outperform. Tom Lee actually just about 2 days ago reaffirmed that he believes the Russell 2000 could rally 50% this year. And there's only about 6 months left in this year, so that would be quite a rally. Here in this video, I will explain what is coming next for markets, the only logical path forward ahead, and whether or not Tom Lee will be correct. And I think the easiest way to look at this is quite simple. Keep it so simple it's stupid. I mean, look at the S&P, look at the NASDAQ. They're at all-time highs. Why are they at all-time highs? Well, because earnings growth has been strong at big tech names. If we did go into a recession or do go into a recession, big tech is probably the better area to be in. Maybe their earnings will not decline as much as other stocks. And well, if inflation stays high, that's probably another good reason to own big tech. Well, in fact, the economy looks like it's not doing great, but it's not falling into a recession. It looks like small caps, mid caps, your average stock should see their earnings start to trough and start to rise in the second half of this year. That is very positive for equities, and it does look like inflation should be on a downward path. We've gotten multiple reports from multiple different investment banks, including JP Morgan and Morgan Stanley, citing auto insurance that should start to fall. And we know it's only a matter of time before owner's equivalent rent shows that rent prices are actually way lower than what the data suggests. And maybe I shouldn't say rent prices, but the rate of increase or growth in rents is back to a normal trend. You can also see oil has recently fallen from $83.41 a barrel. This was the high that you've seen on April 12th. It's fallen to $75 a barrel, down to about $73, up to $75. It's been in that like $2 range here for the last couple of days. But you have seen a downward trend in oil that has essentially dropped oil prices about 10%. Now, oil is one of the biggest input costs to any business out there, because no matter if it's this hot sauce, there's these little cool little, personal bottles of hot sauce, or this coffee pod, don't know why this is here on the desk, no matter what it is, it was transported to a store. It's an input cost for companies. So commodities are important to inflation, but specifically oil. And inflation does historically track what oil does. If oil rises, usually you see inflation rise, at least in the last couple of years. If oil falls, you typically see inflation also fall. And you could see this quite obviously in the last couple of months in 2023. Oil peaked out really to start October, when markets were going through that correction. And then oil fell all the way from $83 a barrel down to $64 a barrel. And the markets were convinced the Fed was going to cut rates 6 times in 2024. A lot of that disinflationary process had to do with oil also falling. Yes, it rose, right, from July through September, but it did fall again. So I think when you mix commodities falling, economy holding up and doing well, earnings for the average stock, not just big tech, start to materially get better in the second half of this year, especially on a year-over-year comparison basis. Potentially the Fed's starting to cut rates July 31st. That's my expectation. All of this sets up for a very positive scenario for small caps. The only negative scenario is, well, historically, when the Fed cuts rates, stocks tend to fall about 23% afterwards. For about the next 4 months, you tend to see a drawdown. But normally the Fed is cutting rates because the economy is weakened. If the Fed is in a position to cut rates, whether it's July, September, November, December, doesn't matter when it is. The sooner, obviously, the better. But as long as they're able to cut rates into a strong economy or a trend or okay economy, that is very supportive to your small cap stocks. And really just interest rate sensitive names or your average stock out there on the markets. As Tom Lee believes, you could pull $6 trillion of cash off the sidelines and put it into markets. I know we throw around trillions of dollars like they're $20 bills these days. The government debt's up another trillion. Nvidia's up another trillion in market cap in the past month. Blah, blah, blah. It's thrown around easily. But just put this into a little bit of context, okay? That $6.3 trillion of cash on the sidelines is over 3 times the total amount of capital in the Russell 2000. Over 3x. That is almost 3 times Nvidia's market cap size. That is about 6 Metas. That's about 2 Apples. That's a lot of money that is on the sidelines. And how stocks work is if you start to see an influx of cash, right, you start to get more buying pressure onto the markets. Even 500 billion of that 6 trillion going into the Russell would likely cause all-time highs for the Russell. Now, let alone if you get 1 trillion or more, that could obviously be even more exciting. And I do think it's only a matter of time before the narrative changes around small caps, around interest rate sensitive stocks. A lot of Wall Street will sit here and tell you, and you see this on CNBC every single day, it's too early to own small caps. It's too early to own interest rate sensitive stocks. Nobody's really talking about a recession. That's why you shouldn't own them. Nobody's really talking about earnings that will start to get better on a year-over-year comparison basis in the second half of this year. I mean, you're set up in a very good way for small caps, interest rate sensitive stocks, your average stocks for this summer. Now, I believe we're going to get the first cut from the Fed July 31st. There's a lot of debate on this, whether it will be really September, or November, or December. We need more data to be definitive on that. I think if we get the first cut July 31st, that's going to be great news. We have 2 inflation reports from now until then. Last inflation report showed progress on the disinflation narrative. If we get the next one in June that shows progress, and the one after that in early part of July, around July 10th, 11th, or 12th, we should get that report. I don't have the exact date on the top of my dome here. But that'll be 3 reports that should give the Fed enough confidence to start cutting rates, assuming all of them are better than the last report. And the Fed meets for their interest rate decision on July 31st. So there's definitely enough time to still get a cut July 31st. But even if that comes in September, I think that does still set you up for a very strong summer for your average stock. Now, keep this so simple it's stupid. I think when you look at the S&P and the NASDAQ and the fact that they're sitting at all-time highs, really, who has participated in that? Okay, let's be honest. 90+% of the move in the S&P and the NASDAQ to get us to all-time highs has been big tech. It has been Microsoft. It has been Meta. It has been Nvidia, Google, Amazon, Apple now even. These stocks have pushed us to all-time highs because there's such a large market weighting in the S&P and the NASDAQ. Whereas if you look at something like a PayPal, it's done absolutely nothing but decline for 3 years, from 300 down to the 60s, and it's just sitting there. You don't need PayPal to go higher to get the S&P and the NASDAQ on an index basis to go higher. But when those other stocks like PayPal and many others start to do better, they can start to add to the performance of the S&P and the NASDAQ. And I think you're at such an elevated level here that Wall Street will start to look at markets and say, does the risk to reward make sense for the S&P and the NASDAQ? Or is my capital better allocated to other areas like a PayPal, like small caps? Because, I mean, how much more can you get out of already elevated tech valuations, big tech valuations? You're not getting any deals there. You can make an argument you're getting a hell of a deal for PayPal. You're getting a hell of a deal for these other stocks. When Wall Street can get over the hurdle of we're finally going to start to get some cuts, inflation is finally starting to fall, when the markets actually gain confidence in that. Forget the Fed, but when the markets gain confidence in that, that's when money comes off the sidelines. That's when those stocks start to do better. And really, I think that could start as soon as June, this upcoming month, as long as the next inflation report, which comes out the same day the Fed meets on June 11th, is also good. I'm sure if that inflation report is also good, the Fed's going to sound even more dovish than they have been before. Let's be honest. Jerome Powell is begging for a reason, literally begging for a reason at this point to start cutting rates. And when the markets realize what's coming next, you're going to see a lot of cash come back into the markets very quickly, as long as the economy avoids a recession and the economy does not get too bad. Now, the durable goods orders number we had on Friday was definitely not great, but it wasn't a disaster at the same time. It could have been a lot worse, and I think that's why stocks, did well. It was just weak enough to say the Fed probably doesn't need to raise rates again, but it wasn't so bad that, we need an imminent cut, which would have been seen as a negative for markets. So long story short, I actually think Tom Lee could be correct. If we do get the first cut coming July 31st, and that's because inflation is falling, not because the economy is weakening, I think you could be setting up for a lot of cash to come back into our markets in a relatively short amount of time, which could cause a catch-up effect to the broader markets. You may be familiar with this. It's called a catch-up or a catch-down. So what happens when you get such a disparity in what's going on in markets, and it changes from time to time, right? Right now, the last really couple of years, it's been big tech's doing really well. Everything else is not. Either you get a catch up and everything else starts to do better, or you get, let's say you're here, you get a catch down where big tech comes down and matches the rest of the markets. I think it's a lot more likely right now you get a catch up and the rest of the markets need to do better and catch up to some of the performance that you've seen in your tech stocks. And I should also mention, the sooner the Fed is able to cut rates and the economy stays well, that also reduces the odds that we head into a recession. So at the same time, you potentially create a better environment for capital allocation into interest rate sensitives or small cap stocks. At the same time, you're actually lowering the odds of a recession, which is a double positive for small caps, right? As I just mentioned, but recession odds falling, that's also fantastic for your small cap stocks. So yes, I do think Tom Lee could be correct in still assuming that we could see a 50% rally in small cap stocks. Just to put, numbers to screen here, numbers to paper, number to screen works a little bit better here. That would be a 50% rally from here. Gosh, I gotta kind of scroll out on the computer. It'd be impressive. It'd be very impressive. You'd get basically back up to this trend line, which makes a lot of sense to me. That would be around 305, around 300 or so for IWM, which again, if these things come together, is definitely possible. And this would just really connect your multi-year trend line. And that's probably where we should be at right now. Again, on a relative basis to the S&P and the NASDAQ, where you have blown past all-time highs, just to get a similar catch-up would definitely put you to 300 or higher for the Russell. So let me know what you think about this information down below in the comment section. hit the like button as well as subscribe to the channel. Let me know as well down below in the comment section where you are allocating in your portfolio. Are you buying cryptos? Are you buying small caps? What are you buying right now? I would love to hear your thoughts. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.